The financial services industry has a massive incentive to make this seem much harder than it actually is. Because if you figured out that you could build serious wealth with only 4 exchange-traded funds and about 15 minutes of setup time, well, that would be terrible for their business model. In this year of 2026, we are surrounded by more financial noise than ever before, with artificial intelligence bots and complex trading algorithms promising overnight riches. But the truth is that the most successful investors are not the ones with the most complicated spreadsheets or the most expensive advisors. They are the ones who understand that simplicity is the ultimate form of sophistication. I want to show you exactly how 4 specific exchange-traded funds can give you everything you actually need for your future. We are talking about full market exposure, protection when the economy gets messy, serious long-term growth, and a reliable stream of passive income. One of these funds even kicks off enough cash that after 30 years of consistency, you could be looking at over $16,000 every single month. This is not based on some revolutionary new strategy or a high-risk gamble with digital currencies. It is based on owning pieces of actual, profitable businesses that provide goods and services to billions of people. Before we dive into the specific codes, we need to address why most people are currently failing, despite having more tools than their parents ever did. Here in 2026, the average investor's portfolio is an absolute mess of overlapping assets. I'm talking about 20 or 30 different funds, half of which are doing basically the same thing, but charging you different fees for the privilege. You might have 3 different growth funds that all own the exact same technology stocks, or 2 value funds that are fighting against each other. It is like going to a restaurant and ordering every single item on the menu, instead of just picking the few things that actually provide nourishment. All that complexity does not make you more money. It only makes you more stressed and more likely to panic when the market takes a dip. The people who do best over the long run are the ones who get out of their own way and let the math of the world economy work for them. Think of your portfolio like building a house. You do not need 47 different types of hammers to get the job done. You need a solid foundation, sturdy walls, a reliable roof, and functioning plumbing. Everything else is just showing off and adding unnecessary costs. Your wealth works the same way through 4 distinct roles. Role number 1 is your broad market foundation. Role number 2 is your resilience against economic storms. Role number 3 is your growth engine for the future. And role number 4 is your consistent income stream. Let us break down the first quadrant of the wealth system, which we call the foundation. For this, you want the Vanguard Total Stock Market Index Fund, which traders know by the ticker symbol VTI. This single fund holds over 3,700 different stocks. It gives you ownership in everything from the massive tech giants in Silicon Valley to a small industrial company in the Midwest that you have never even heard of. When technology stocks take a breather, perhaps healthcare or consumer staples hold the line. When large companies stall, the smaller companies in this fund might start to run. You are not trying to predict which sector will win this year or next. You are simply owning the entire game of American capitalism. The expense ratio for this fund is an incredibly low 0.03%. In the world of finance, that is basically free. It means you keep nearly 100% of your returns, instead of handing them over to a fund manager who is likely underperforming the market anyway. If you were to put just $9 a day into this fund and leave it alone, the results over 30 years would be staggering due to the power of compound interest. Now, while a broad foundation is essential, you also want focused resilience. This brings us to the second quadrant, where we find the Vanguard S&P 500 Exchange-Traded Fund, known as VOO. This fund tracks the 500 largest and most profitable companies in the United States. These are the businesses that have survived the financial crisis of 2008, the global health crisis of 2020, and every other meltdown in between. These companies do not just participate in the economy, they essentially run it. When you own this fund, you are betting on the leaders of the world. You might wonder why you should own both the total market and the S&P 500, since they overlap so much. The reason is focus. If the total market is like owning every team in the league, the S&P 500 is like buying extra shares in the championship contenders. When the markets are strong, this focus helps you capture more of the gains from the biggest winners. When the markets are weak, the stability of these massive corporations tends to hold up much better than smaller, riskier firms. Over the past decade, this fund has returned over 160% in price appreciation alone. It is a boring, predictable way to build a massive pile of wealth over time. But foundation and resilience are only part of the story if you want your portfolio to truly accelerate. That is why we need the third quadrant, which is focused entirely on growth. For this role, we look to the iShares Russell 1000 Growth Exchange Traded Fund, or IWF. This fund focuses exclusively on large companies that are reinvesting their profits aggressively to build the future. These are the businesses driving artificial intelligence, next-generation healthcare, and digital infrastructure here in 2026. They are not sitting around paying out large dividends to shareholders right now. They are using every dollar they earn to take over their respective industries. Because of this aggressive stance, this fund can be more volatile than the others. You will see bigger swings up and bigger swings down. But that is the price you pay for the kind of returns that can change your financial trajectory over 20 or 30 years. Over the last 10 years, this growth engine has almost quadrupled in value. It is the part of your portfolio that brings speed and ambition to the table. However, building wealth is not just about seeing a big number on a screen. Eventually, you want that wealth to pay you back in cold, hard cash. This brings us to the fourth and final quadrant, which is income. The king of this category is the Schwab U.S. Dividend Equity Exchange Traded Fund, known as SCHD. If there is one fund that deserves to be called a cash flow machine, it is this one. This fund does not just look for companies that pay dividends. It looks for companies with strong balance sheets, high return on equity, and a proven history of raising their payouts every single year. To even get into this fund, a company must have 10 consecutive years of dividend payments. This filters out the junk and leaves you with a portfolio of elite, profitable businesses like Coca-Cola, Home Depot, and PepsiCo. The dividend yield is currently around 4%, which is real money hitting your account every quarter. But the most impressive part is the dividend growth rate, which has averaged over 11% annually for the last decade. When you reinvest those growing dividends back into the fund, you create a snowball effect that is nearly impossible to stop. Imagine a scenario where your income grows by double digits every year, regardless of what the stock market price is doing. That is the power of the fourth quadrant. Now that you have the four pieces of the puzzle, the real question is how to put them together in a way that fits your specific life goals here in 2026. The beauty of this system is its flexibility. If you are in your 20s or 30s and you have decades of earning power ahead of you, you might want to lean into the growth-focused strategy. In this setup, you could put 70% of your money into the Growth Fund, IWF. The remaining 30% would be split equally between the Foundation, the Resilience, and the Income funds. This configuration is built for maximum appreciation, aiming to grow your total net worth as fast as possible. You will not see much cash flow today, but you are building a massive engine for tomorrow. On the other hand, if you are in your late 40s or 50s and you are starting to think about what life looks like after your career, you might prefer the dividend-focused strategy. In this version, you flip the script and put 70% of your money into the Income Fund, SCHD. This creates a portfolio that behaves like a private pension, sending you checks every few months that you can use to supplement your lifestyle. Even with 70% in dividends, the other 30% in growth and market funds ensures that your principal continues to keep pace with inflation. The most important thing to remember is that neither of these strategies is inherently better than the other. They are simply different tools for different stages of life. What they share is a commitment to simplicity and a rejection of the high-fee, high-stress world of active trading. The biggest enemy of your financial success is not the stock market. It is your own behavior. Most people fail because they try to outsmart the system. They hear a tip on social media or see a scary headline on the news, and they decide to change their entire plan on the Tuesday afternoon. They sell when things look ugly, and they buy when everyone else is bragging about their gains. By doing this, they are effectively transferring their wealth to the people who have the discipline to stay the course. The market is going to crash again, perhaps later this year or sometime in 2027. When that happens, the people who have a complicated mess of 30 different stocks will panic because they do not truly understand what they own. But you will be different. You will look at your 4 exchange-traded funds and realize that you still own the 3,700 best companies in the world. You will realize that the machines in the factories are still running. The software is still being updated, and the dividends are still being paid. A market crash is not a reason to leave. It is a sale on future wealth. If you can maintain your discipline and keep putting in your $9 a day, or whatever amount works for your budget, the math of compounding will do the heavy lifting for you. You do not need to be a genius to get rich in the stock market. You just need to be more patient than the person sitting next to you. Take 15 minutes today to look at your current accounts. Identify the financial vampires that are sucking your returns away through high fees and unnecessary complexity. Clean up the mess and move your capital into the 4 quadrants we discussed. Set up an automatic contribution so the money leaves your bank account before you have a chance to spend it on something that loses value. Then, the most important step of all is to go live your life. Spend time with your family, pursue your hobbies, and excel at your career. Stop checking the price of your portfolio every hour. The forest does not grow faster because you are standing there watching the trees. Trust the system, trust the elite companies you own, and let time work its magic. By the time we get another 30 years down the road, you will not remember the noise of today. You will only remember that you made one simple, boring decision that changed everything for your future self. That is the whole game. Everything else is just a distraction designed to keep you from your own freedom. Stick to the plan, stay consistent, and I will see you on the other side of financial independence. Thank you for taking this time to invest in your own knowledge. Your future is waiting for you to take control.